Good afternoon, everybody. I'm your chair. That's that's what I hear. So I will start our discussion on climate risk and disaster finance and insurance. And of course, after a few words of introduction from my side, I will ask Pablo Saavedra, the Vice President of the World Bank, to deliver maybe a more serious keynote than my own remarks, and then turn to Diego Guevara from the Finance Ministry here in Colombia to moderate the discussion. And I'm sorry, probably I will have to leave you before the end of the event, but I have many colleagues in the room, and we will capture, of course, the conclusions so that we can put it in the final communique of the summit. As an introduction, I want to really thank the organizers and the participants of this meeting. It's a great pleasure to be here in Cartagena in Colombia. We all know the journey of the country to push for sustainable finance. We know the role played by the finance ministry on this. We know Bancoldex, our host, Findeter, Finagro, FDN, so also the experience of Colombian public development banks. And we know the country, like all countries now, is severely exposed to the impact of climate change. So it's really a good place, the right place, and to have this discussion. I'm also extremely pleased to introduce this event because it's organized with the World Bank. So Pablo, you know how important your presence here is within the FIX community, and well, we see the consequences of your presence. I mean, we are tackling very important, serious technical issues with the intention to make concrete progress and proposals by the end of our meeting. No need to stress the fact that this side event is timely and important and is a direct answer to a priority that is so strongly set by the international community. So we now have a very clear mandate as financial institutions to deal with these innovations and this situation because of reality, of course, exceeding what we did in the past, alas, and also because, well, it was discussed within, I was part of the Bridgetown initiative, of course, led by your neighbors of Barbados and Prime Minister Mia Mottley. It grew up in so many meetings, and I was in the room maybe with you in Paris during this new Global Financing Pact summit last June, and it was really a hot topic, including between leaders themselves. So we received that guidance that we have to factor in vulnerability at large, and also that we have to reinvent, change the way we do business, and test new instruments that could be replicated and become market practices. So we have a mandate. Second, public development banks, this coalition certainly have a crucial role to play. So as you know it, the discussion maybe has focused mostly on this idea of climate resilient debt clauses that we will discuss. There was even a specific call to action at the end of the summit in June with UK, France through AFD, the US, Spain, Barbados, as well as key MDBs, notably the World Bank and IDB. And so there are expectations for this group and others, if you like, to make progress on this very specific issue of inserting this type of clauses within our contracts. And probably it's true for public development banks, but the idea is to go beyond and to have also private finance hosting this kind of mechanism, and hopefully demonstrate over time, maybe as soon as COP28 in Dubai, that we are moving forward. Of course, this is only one of the instruments in a mosaic of financial tools that we have to discuss. But we have to keep in mind that there was a special attention to this very mechanism, and we certainly have to deliver something on this. Actually, AFD I'm heading is ready to go that direction, but if we do it alone, probably it makes no sense. We tried in the past to this type of innovation, and it has to become shared by as many institutions as possible. We can go also in the direction of contingency loans, insurance mechanisms of various kind, etc. All that we will discuss today, so that risk reduction strategies are complemented by risk financing strategies. One special point, we have to pay attention to the role that national public development banks could play. It's a discussion that is mostly, as far as I between international institutions. Of course, the national development banks, because of their knowledge of the specific context of climate vulnerability, because of their traction, influence on other local banks and local actors, including at the political level, and because they can play part of the counter-cyclical role that is needed when an extreme event happens. There are many examples. I'm thinking of what the Fiji Development Bank, for instance, did back in 2015 when Cyclone Pam happened and made terrible consequences on the island. So maybe in the discussion, because this is what FIX is about, see in the different layers of this community, what is the comparative advantage of each of us. And Alan is there, of course, to explain the Mexican experience on this. Last but not least, we have to go, of course, way beyond public development banks. So insurers, private finance, and also the governments and the regulators. So maybe that's where our moderator could also provide the substance of what is happening here in Colombia, so that we reach suitable regulatory supervisory frameworks to encourage both the financing of resilient assets and also guaranteeing the stability of the financial system when this type of events, extreme or slow, sometimes happen and transform the way the financial system is able to face these physical risks. So we also need, it's a question mark for us, we also need to increase the support to regulators and to other actors and with probably other instruments than credit lines or what we are used to do. AFD, for instance, is working on greening the Caribbean financial system with the Caribbean Development Bank and other actors, and we are doing it, trying to do it actually in other regions in the world. And the link between banks and insurers probably will come in the discussion and is particularly promising. And certainly here, public banks could also play a role. I will stop here, concluding by we need to build, we need to share, we need to have a place to share these experiences. They're all too little, probably. They're all fragmented. And so this side event is one of them, but we need something a bit more structured. So I really commend the G7 Global Shield initiative. France, through AFD, is part of it, with our German colleagues, Denmark, others. So this is a very important place to build and share. But if finance in common differently probably can play a role also, having some sort of innovation lab at a time, and probably beyond only the subject we have already or to be discussed already. Please tell us in the conclusions, and we would be ready to see how to do it. So I stop here, and I turn to Pablo for his remarks.
Thank you, Remy, and welcome everyone. Good afternoon. It's a pleasure for me to talk a little bit about what the World Bank has been doing in terms of managing financial exposure to climate disaster risks. We have been working across different regions, different countries for many years. And also, it's going to be very interesting for me to hear from you and your own experiences. And I think there's a role also to play for national development banks, and I'll get to that in a minute. But I wanted to start by sharing a number. Over the first 6 months of 2023, this year, $110 billion have been lost to natural disasters across countries related to climate. Just the first 6 months. You can imagine, with El Niño taking place and heating up temperatures, what's happening and what's going to happen in the rest of the year. So this number, the 110 billion in the first half of the year, it's larger than the average over the last 10 years. So I think we have a serious issue in terms of losses. We have a serious issue in terms of how countries can cope with these losses. The larger countries have more instruments, have more resources. The medium and smaller countries is harder. And what we have been seeing for decades already is that disaster-prone countries, climate disaster-prone countries, have experienced high levels of deficits, fiscal deficits, when disasters strike, and of course that leads to higher debt. And then on top of that, after the disaster, they have a couple of years of very poor revenue collections. So it's a double whammy on the fiscal side, aside from the destabilizing effect of that in the economy overall. So there has to be ways, and we have been working with countries on ways to deal with this situation. Actually, the World Bank launched, Remy was referring to it, in Paris. We launched a new toolkit that contains debt pause options, debt clauses, commonly known, changes to our catastrophic financing drawdown options that we have that first build on policies in the country to prevent and to have the structures to deal rather with climate disasters. But then when the disaster strikes, the financing goes immediately. But we're making changes to expand the access to it, expand some of the features that these instruments have. And of course, we're working, and we'll discuss a bit more, and we're working with a number of other instruments. Now, through our engagements with countries, we have learned a number of lessons And I will bucket the lessons that we have learned in three. The first one is that to deal with these kind of situations, countries need a large number of ingredients. They need a mix of policies. There are adequate policies to prepare for these situations. They need a lot of technical expertise, capacity building inside to be able to deal with these situations. And then on the financial side, they need a multi-layered approach to deal with the situation. And what I mean when I say multi-layered, it's important to have your contracts, and now we will see more and more that have a debt pause option. So then you don't pay when you are in trouble, when disaster strikes, when a hurricane strikes. It's important to have insurance, and many countries have been availing themselves of regular insurance or the new ones that we are doing, the cat bonds, that are catastrophic bonds that help to secure resources when they are needed the most. But also other instruments that may help, like the one that I mentioned, the drawdown options on catastrophic loans, basically, again, policy reforms up front, and then the loan is contingent immediately upon the declaration of emergency by the country. So it's important for countries to have all these instruments, because what we have seen is that countries that are not well covered end up with very significant costs on the fiscal side, higher debt, and the economy is even more destabilized on those times when there's no resources to push through the different channels very immediately after the disaster. So that's the first part. There's a mix of things that need to be in place. The second lesson, and obviously is very related to the first one, is that it's important to have a comprehensive approach to the coverage. It's important that the governments are covered, but it's also important that the firms are covered, and it's important that the households are covered. So on the government side, I'm not going to repeat, there's a number of instruments that they can avail themselves, but there's also a part on the fiscal side that is not commonly discussed, and is more and more we are seeing countries that are improving their capacity by creating fiscal rules that are actually solid, that make sense at the right time, and also that come attached to a disaster risk fund linked to the operation of the rules, where they can accumulate resources that are in the good times, that then they can use when disaster strikes, and where actually they can also receive resources from development partners, but then linked to a fiscal rule that keeps the fiscal function in place. And I think we will see more and more of those because the resources and the impact that can bring is quite important. So that's on the government side. But on the firm side, and here's where national development banks play a role, it's very important that the companies, particularly the ones that are exposed to physical risk, or they are exposed to territories where their sales will be significantly affected, are well protected, no? And we have been working for many years in Latin American countries with credit guarantees for SMEs, and now we are working in Africa, in Burkina Faso, in Rwanda, with this type of products that are catered through the national development banks for SMEs. And there are a number of other products that I look forward to hearing from you, because they are already embedded in some of the work that some of your organizations are doing. And then households. This is another part of the function. We have seen regions of countries where poverty rates increase drastically, sometimes double-digit, because disasters strike. And those poverty levels are very hard to be reduced over time after a disaster comes. So having targeted safety nets precisely for for natural disasters caused by climate and others, it's very critical. I think we have a much more mainstream, the typical safety net, but protecting specific populations, pockets of populations through this is also critical. And of course, beyond the country, and we have discussed in this forum here in Cartagena a number of mechanisms that are more regional. We are financing, or we're helping to with other partners to structure a CAT bond, a catastrophic bond for the Caribbean. We have done that in other regions. It's important to have regional schemes, particularly when you talk about insurance, pooling is critical. So if you have many countries and there's a price, of course, a premium for the even if it's supported and financed by others, it's important to do some risk pooling. So regional approaches are also critical. We are also working in Africa on this the same way that we have been working in Latin America. And the third bucket of lessons, it's about coordination among different levels of government. And again, I think the development banks, national development banks, can play a role here. There are many development banks that operate at different levels of government, and that's very helpful in looking at these issues in particular jurisdictions where these are very disaster prone, and having all the scheme for coordination. Countries like Mexico historically have a lot of experience on that, for example. And so those are the three buckets that I wanted to discuss. But I wanted to just finish with one item, and I think is that the national development banks, as I mentioned, they play a role. They play a role on the financing, but they play a role in the developing of new products that could be available. I think that there's a space there that needs to where we all need to work together and developing new products for that can fit the needs of obviously of the firms that they serve in their countries, and obviously the needs of the national development banks themselves. But there's a big space, and also they play a role in encouraging their own clients to be insured against climate disasters, because losses are big, and I think commercial banks are starting to do that much more often. Some national development banks are starting to do that too, but I think that needs to be more mainstream. No, so it's important to have that as well. So let me stop there. I'll actually look forward to the more detailed discussion that you will have, and to learn from the experiences that you have in different countries. Thank you, Remy.
Thanks a lot, Pablo. Fantastic. I now turn to Diego, Mr. Vice Minister. You have the floor, the moderation.
Thank you very much, Remy, and welcome to Colombia, all of you. It's a pleasure to have all of you here in Cartagena, amazing city. I hope that you enjoy your time far from the conference and event. I hope that you can also enjoy the city. Okay, just to start, I would like to do a short and brief presentation about what we are doing in Colombia, in just 3 minutes, and then we are going to move to our special panelist for tonight. And basically, I think that when we start to talk about the increasing financial protection and climate shocks, I think that there is an important fact about uncertainty. Usually, John Maynard Keynes, the famous British economist around 100 years ago, he started to talk about uncertainty in economics. And basically, when we talk about climate shocks, the hardest thing is that it's not just about probability, because we don't have a distribution function. We are talking about a completely uncertainty, and then we need to start to know how to identify, how to evaluate, how we are going to respond and try to minimize the effects of all of the different risks that we can generate. And in this landscape, just for the specific case of Colombia, in our Ministry of Finance, basically we have like a climate action plan, what we have like, let's say, 2 pillars. A first pillar is focused on the physical risk, and a second point in terms of transition risk. I think that when we talk about physical risks, basically, or we are going to talk about how we are going to address those damage and losses that we could have in the case of disasters, in the case of extreme climatic events, and how we are going to respond this at the same time when we are facing pressure over public finance. Usually when we are in the emerging economies, the fiscal rules that maybe that Pablo was mentioned before is a great challenge. How you are going to achieve your fiscal balance when you are in emerging countries and when you have to respond and when you have to address a climate shock. So I think that this is an important point. And the second point that we used to talk is about transition risk, because basically when we're talking about ecological transition, we just not should talk about environmental or energetic transition. Also, we should talk about how we are going to do a transition in terms of our balance of trade. I think that it's an important point. So basically, what we have been doing in our plan, we create a national disaster risk management in 2012, and basically 10 years ago in this plan we incorporate some financing mechanism trying to modify and implement in this program. And basically in 2021, before 2 years ago, basically we have a specific strategy for financial protection for disasters, and it's, let's say, it's an ambitious plan in terms of quantification and evaluation. And basically, with this plan, we want to focus in on ex-ante financial instruments. We have to be prepared. It's not just how to respond, also how we are prepared. And basically, I think that we are pioneers in terms of definition of this kind of strategy in the long run, in terms of some specific metropolitan cases. There are some territorial strategies because the climate shocks are different. When you have a country as Colombia, or you have like let's say like Amazonic jungle region, Andean region, Caribbean region, the different climate shocks could have different behaviors in each area. So basically we have different plans for the case of our islands in the Caribbean, San Andres and Providencia, but also some specific plans and also financial instruments for specific cities as Putumayo and Bogota. And I think that it's really important. It's important to remember this idea that one size doesn't fit all, and when you have different regions with different climates, it's important to have different strategies. I think that probably it's important in terms of how we are going to address many macroeconomic risks of the climate shocks. I think that is the main message. I think that we are running out of time, so I don't want to go deep in Colombia. Now I would like to present our panelists. So in first place, I would like to present to Mr. Christian Kremer. Christian, he has an extensive experience in development after being director of KfW in Afghanistan, Pakistan, and currently he is director of the General Strategy for Latin America, and he is also a member of the committee. I would like to start with the first question for Christian, as we were talking before about this ex-ante experience. How can DFI support this ex-ante risk management, and if you can tell us some examples regarding to your experience?
Okay, do I only have 3 minutes once? Or
yeah. You have once 5 minutes each panelist. I forget to tell you the rules. I apologize. Each of you have 5 minutes to respond to the question. And
okay, so then I take the chance to not answer your question, but to take the point of Pablo and Pablo's request on DFIs being innovative of finding new ways and in order to cope with disaster risks. And KfW already supports a broad portfolio of risk finance approaches to tackle climate losses. But I want to introduce you a recent example we have just structured. And it's a pilot for linking insurance to lending. So KfW supports the West African Development Bank, BOAD, to start a shock-resilient loan program. So loans of BOAD are combined with the insurance from Munich Re and the African risk capacity in order to tackle defaults and payment in the case of a natural disaster for a certain period, up to 2 years. KfW, on behalf of the Ministry BMZ, supports the product development and provides premium subsidies. This will start in January next year. So why do I think this is a good example of innovation because I think two aspects are quite remarkable. First, this payment schedule ensures the early and speed access to finance once a disaster happens, and so tackles the so-called knock-on effects of every disaster. And the second thing I like about this example is it's a structure with Munich Re. And as we see here, Swiss Re. I mean, one thing often discussed at the moment here and also at this conference is mobilizing private capital, which is not an easy one. But this is, I think, it's a nice example of bringing a company like Munich Re in such a structure. And therefore, I think it's quite an innovative example, and maybe there's time to further discuss this. Thank you.
Okay, Christian, thank you very much for respecting the the time. Still, you had like 3 minutes left if you want to add something. Okay, perfect. Okay, in second place, I would like to welcome Mr. Jan Duran. I guess that it's online. Jan has been working in development of the Caribbean for more than 30 years. After experience in the Central Bank of Barbados and Cartac, he has worked in the CDB for almost 20 years. He's now the director of the economics department of the CDB, and his areas of expertise include macroeconomic, debt dynamics, sustainability, analysis, and competitiveness. I would like then to go to Jan with our second question of this panel. I would like to ask to Jan, following his experience regarding what the role do they play following your experience in the public development banks, what is the role in increasing financial resilience for the poor and vulnerable, that it's an important characteristics of our region and the Caribbean? No, I suppose that should be appearing. Oh, sorry. Sorry, I thought that was there. Somebody told me that will be
the name
online.
tag is there, but I'm right.
Sorry, and
Well, thanks. First of all, Diego, thanks for your warm welcome. My first time in this beautiful country, and thanks to the organizers for inviting us to participate in this very important panel. Well, I think the first thing that I should say is that the Caribbean, and when I say the Caribbean, I'm talking about the 9 small island states that constitute CDB's borrowing member countries. They're pretty much ground zero as far as the climate crisis is concerned. Basically, the damage from natural hazard events in the Caribbean as a percentage of small states generally is 4 times that of other states. But in the Caribbean, the damage from natural hazard events is 7 times that of other states. The frequency of natural hazard events in small states again is 7 times that of other states. And basically we are in the Caribbean, we are already encountering grave difficulties in adapting to the impact of climate change, including the increasing intensity of extreme weather events, declining freshwater availability, rising sea levels, and so on. But in addition to this, our countries are highly indebted. In fact, about half of the countries that constitute our borrowing member countries have debt to GDP ratios above 60%. So one can imagine that while addressing the issues related to climate change are necessary, it is also difficult because the countries do not have the fiscal space to so address. Basically, the challenge is that in order to mitigate the impacts of climate change, we are talking about spending much more on infrastructure than one would have to do normally. So this is the challenge faced by our countries. Now at the same time that these mitigation efforts are necessary, it is also more expensive as well because of the risk, the greater risk associated with our countries. So as a regional development bank, our task really is to seek to mobilize resources for the purpose of mitigating against the impacts of climate change. And that requires, among other things, partnerships. We've been partnering with Canada to, Global Affairs Canada, to provide resources for parametric insurance through the Caribbean Catastrophe Risk Insurance Facility. So not only do we encourage all of our countries basically to pursue parametric insurance against natural hazard events, but we also facilitate by mobilizing resources to assist them in making those payments. I think one of the things that we are currently also working on is a fairly comprehensive diagnostic of gender-sensitive, innovative disaster risk finance instruments, basically to determine the range of suitable instruments that can be implemented to strengthen our financial and social resilience to disasters. We've also established a disaster response policy-based loan instrument that incentivizes upfront disaster risk management and climate change policy actions as a basis for eligibility for budget support in the event of a natural hazard impact. And of course, like the World Bank, we are implementing as well debt service pause clauses that would provide our countries with fiscal space to respond to the impacts of natural hazard events by pausing debt service payments on our loans. And finally, we are also trying to support parametric insurance coverage for our water utilities.
Thank you very, very much, Jan. Okay, now we're going to move with our third panelist, Alan Elizondo. Alan is director of the General Trust Funds for Rural Development in 2019. His former professional development took place in Banco de Mexico, where he specialized in financial risk management and development banking. And basically, now that you are running like the FIRA as probably national financial institution in terms of local approach, I would like to start our discussion with a single question. And what could the role that you can provide from your institution in terms of, from your experience also, in terms of providing climate risk and disaster finance and insurance solution to the borrowers, and what could be the mechanism in terms of role of partnerships? And welcome, Alan, to the panel.
Thank you, Diego. Thank you also to World Bank for the invitation to share this panel, Agence Française also, and also the IDB, who's sponsoring our institution to be here. Let me start this question, the answer, by giving an example. Mexico is a very often country that is struck by disaster, and the example goes around the earthquakes. We have been hit in 1985 and 2017 by several earthquakes, and we have learned several things. Someone that has a house or an apartment and faces an earthquake, he would have liked to have two things before the earthquake. One thing, very important, the insurance and the coverage, that would be the basic. But the second thing would be to have a more resistant house. And that is a lesson that we have learned very well in Mexico, because now costs of construction in the city have changed from learning this experience. And today, if an earthquake comes, let's say 7 degrees Richter, it is very rarely the case that we will have a disaster. And that's exactly the point. We call this adaptation and resiliency, and this brings me to the topic of the table. Something that we have learned by working in development banks is that we have to work not only in insurance, but also in the resiliency and adaptation of our producers, smallholders. Our institution works in agriculture. And this calls for a lot of things. Our institution has worked for mitigation measures, but not exactly on how to prepare people to be more resistant, adaptive, and resilient for this type of disasters. Earthquakes is an example, but climate change is something that resembles very much. What we did, or the question that we have to answer, is how a second-tier institution from the government can work to do that exactly, to promote adaptation and resiliency. You have to start first by having a definition on adaptation and resiliency. What are the risks? What are the vulnerabilities? And here we call to the partnerships we have built, particularly with the Agence Française. We have worked on exact definitions. We have worked with our customers on what are the risks that they are facing, the new risk on climate change, and what exactly are the activities that we need to do in order for make them stronger. So the work has led us to build taxonomies of instruments that will provide our smallholders with at least three concepts. First, the community resilience. So we have identified, with the help of the Agence Française and some specialized consultants, certain technologies that will help to provide some more resilience to the communities that are producing in our country. Mechanisms of risk prevention and measurement. So we have also identified some certain elements that we can finance that will help them to measure the risk and prevent risks. The third one will be to help them to build the critical infrastructure that is required for them to resist for climate change. The help has come not only from multilateral institutions, it has come from local public entities, such as our local Climate Change Institute, that has pointed out exactly what are the vulnerabilities and the municipalities that are more prone to disaster. And then we have gathered all together so that this taxonomy is already in place in Mexico. Now, what is the next step to make this actionable? Well, on the first place, where to get the resources, the money to finance all this. Again, we have had the partnership with multilateral entities to channel resources from multilaterals through our institution to the market. And the market has financed these concepts. It is in the number of 88 concepts that are providing this resilience and adaptation to our smallholders. But most important, and this is something that Monsieur Rioux commented, how to make not only public money to flow to this objective. What the next step has been to use this taxonomy to back the green bonds, and green bonds that are tagged resilient green bonds. So it is 6 months ago that we issued the first green bond that is resilient. And at that day, we just joined the pension fund industry to the resilient, to concepts that are at the end helping our population to become more resilient. That is the role we see for PDBs. That is something that, as I stress, calls for partnership, and is exactly what we wanted to share today. Thank you.
Thank you very much, Alan, for telling us your experience with the specific cases of Mexico. Okay, now we're going to move with Ruben Hofliger. Ruben is the head of public sector solution in Latin America since 2019, after working as head of Latin American partnerships and risk officer in Swiss Re. Previous experience include general director and coordination of Fondo de Desastres Naturales in Mexico for almost 10 years. Now that we're going to move to this experience with the private sector. I would like to talk to you about how we can think the leveraging from the private sector to bring climate and disaster risks in developing countries to scale. And thank you very much for being here, Ruben.
To the contrary, thank you very much for the invitation to participate, and happy to share some of our experiences. The problem of being one of the last ones to talk is that many things have already been mentioned, so I'm going to try not to repeat myself, but focus on some of the specific topics mentioned. Innovation, data, social, de-risk, long-term commitment. Innovation. A lot had been said already about parametric cat bonds, other types of innovative risk transfer solutions, which is needed. And then I link it to data. Why data? Data analytics, climate risk assessment, cat modeling. In order to be able to do a proper analysis of your risk and be able to transfer it to the insurance, reinsurance market, you need to have appropriate data. And that's a huge challenge we have across the globe. Latin America is not the exception. We need adequate data in order to be able to properly model the risk. Then moving to social. What do I mean by social? Social safety nets. And this has a lot to do with topics like what Alan was mentioning. When you provide a loan to a low-income farmer, you need to make sure that that's protected. If there is a massive drought, a massive flood, they are able to recover with an insurance protection, or those social programs in which if you provide a life or mortality cover to the householder in case they die, the families not get unprotected, or as well housing. We have a project also in Mexico with the National Commission of Housing, in which there is a lot of social programs to build new houses for low-income population, but also to reconstruct those houses that were impacted by a hurricane, an earthquake, and so forth. But the problem is that there is no specific public policy around protecting those investments on social programs, investments on new houses or reconstruction, or sometimes in the case of agriculture sector. That's about changing the public policies and investing in having insurance in case there is another event that houses will be protecting during the phase of construction, and also providing a coverage to that population for at least 1 or 2 years, so they can also build that conscious of insurance protection, conscious of being protected against an event. De-risk, I'm going to quote my colleague Christian about, we have a similar solution in Swiss Re called financial embedded risk transfer, which is, and I'm going to quote Ian as well, it's more, we call it deferral option 2.0. It's more than just debt pause, but what we are trying to do is really to have an embedded insurance within the loan that in case there is a massive event, hurricane or an earthquake or a massive flood, the insurance coverage will pay the debt of the sovereign, so the sovereign can use their own money to pay for the emergency relief. That could be paid a certain period of time for the interest or the loan itself, so they can use their own resources to attend the emergency and get back to normal as soon as possible. This could be, of course, complementary to what some multilaterals and development banks are already providing as a debt clause or deferral option, but we do believe that we need to make the next step, which is really getting to helping the countries not only with the pause, because at the end you need to pay it, and with higher interest we need also to help them to be protected. And finally, talking about long-term commitment, this is what at least the insurance sector requests from all the parties on a public-private partnership. We need to make sure that we have a long-term commitment with the governments, with the multilaterals, with all the partners involved in a project, because what we have seen is sometimes insurance is only reminded when there is how we call it, a house burning, like El Niño. Everybody wants insurance now. In the agriculture sector, in almost all the countries, everybody's talking about insurance. The problem is that when you know that it's already happening, it's going to be very difficult to cover what we call a burning house already. So we need to make sure that we have a long-term commitment, so when those type of events are forecasted, you are already protected and not looking for protection at the moment. So with that, I'll stop here. Thank you.
Thank you very much, Ruben. As Christian had 1 minute left, he just told me if he can give a short comment to 30 seconds. Christian, thank you very much, and go ahead.
1 minute, so I have 1 minute to comment on this, Ruben. Thank you very much. I think it's very important to stress that if you want to mobilize private capital in a larger scale, you have to add to the pure concept of pause something else. Otherwise, if you stick with pause, you will not mobilize private capital on a larger scale. So I think that is exactly when insurance comes in and is getting more important.
Thank you very much, Christian, for your remark. And now we have our online invitee, Michael Baca. Sorry, I confused with Jan. I thought that he was the one online, but our online invitee is Michael Baca. Michael Baca works for the Risk in Inclusion and Value Enhancement of Pastoral Economics in the Horn of Africa in SEBRE. He previously worked at financial sector deepening Kenya as senior inclusive finance innovation specialist for 14 years. His main areas of expertise include innovation, change finance, digital economy, and risk and resilience. And I would like also to ask the same question that I did to Ruben, bring your experience from Africa, the other side of our global south, that it's really important also for us. And how do you see this leverage experience in the practice in the private sector to bring climate disaster risks, finance, insurance in developing countries to scale? And welcome, Michael.
Thank you very much. Just to confirm, you can hear me well?
Yes. All the room. Perfect with you.
Good, thanks. I'll try not to repeat what has been mentioned in terms of how to leverage the private sector to scale some of the initiatives that are happening. But I'll start off by saying that leveraging the private sector capital, because I think besides the public, from the international and the local development institutions, we also have the private capital that we need to leverage, and also to have the complementarity that would come towards financing climate and disaster risks. There are some initiatives like the stop loss. I think just give a couple stop loss. We have things like credit guarantees, portfolio risk that Swiss Re have mentioned on, among others that would end up risking the private sector in a way that they can release the capital that the private sector do have in a way that would scale these initiatives. Also, besides the government and the funding institutions targeting at financing some of these risk instruments, crowding in the beneficiary contribution also proves as a way of scaling initiatives. So as the programs are designed, we should be thinking of what's the role of the beneficiaries, also contribution, so that is sustainable and is something that can be scaled. And also the private sector have a major role in terms of add-on product innovations. Besides how the programs, mainly they are huge programs that are designed a couple of years, the private sector have an opportunity to bring in and crowd in additional product innovations that can be aligned to the instrument, the risk financing instrument that are proposed. And this could ride on this instrument. For instance, things like the credit guarantees, which can lead to access to more capital. We have things like the climate insurance, which would reduce the exposures that the private sector do have, can lead to the private sector creating more products outside what is being financed. And We've seen that leading to more hand-on products, which expands the scope. And then I think on the innovation, that has been already touched, but I'll just single out the product innovation. A lot of work needs to go towards product innovation to make it cost-effective, and also the issue of the data, especially the underwriting data. There's still some work that needs to be done on product innovation. Then distribution, I'll single out two areas because the private sector needs to scale the initiative, and especially I like one of the panelists who has mentioned the 3 layers from the farm, there's the community. The distribution becomes very critical to scale. And platform is one of the major areas. We need to think of platforms to coordinate both the public and the private sector, as well as the beneficiary, and then the ecosystem approach. There are a lot of players in the industry, both the development partners, the private sector, the government, and even the business, the private side of the business that need a lot of coordination, and the ecosystem approach where the risk financing instrument flow within the normal business activities of the various players. So how do we mainstream these instruments to including even like the non-profit institutions that work with the communities? How do we ensure these instruments are part of them? And then lastly, on the capacity building, both the private and the public, there's a lot of capacity building that need to come in. And especially on the still single out the training on the product innovations. Yeah, there's still a gap in the product innovations to get the appropriate product that will get down to the communities and that the private sector can scale. And that is tied also to the whole issue of the data. The ability to use the data for modeling and for decisions and to support the underwriting. And this data, how can we get data that can be used across the ecosystem in a way that is acceptable and is shareable, and the instruments are acceptable when designed using common data sources? Thank you.
Thank you very much, Michael, for respecting the time. Okay, we're going to go to our last panelist, Valerie. Unfortunately, the only woman we would like that in the near future we have more women in those topics in economics. It's really important, so I apologize to all of you in advance. It's important to remark we have here Valerie Laxton is Senior Associate in the World Resource Institute, where she leads the center works to promote climate ambition at Development Finance Institution. Prior to joining to the WRI, she worked at IFC as sector economist in the Development Impact Department and also head the Economic and Financial Affairs section at the delegation of the European Union in Washington, D.C. Her areas of expertise include analysis of economic policies, global governance, climate finance, and international affairs. And for our last question, we would like to, following your experience in developments, now, how we can implement CDRFI, this climate and disaster risk finance insurance solution for the poor and vulnerable? Valerie, thank you very much for being here.
Thank you for inviting me to speak on this panel. Thank you very much. So let me first say that financial protection against climate disasters or disaster risk finance is or gets operationalized through a set of tools, instruments, facilities, funds, and now also financial innovations. And Pablo and Christian, you mentioned many of those. And each tool and this instrument is addressing a different layer of the problem. So when we have gatherings like this, I get the impression, or it gives me the impression that we have everything we need and we have the toolkit and it's there, it's ready, we have everything we need at hand. Plus, nowadays the ecosystem, which Michael spoke about, the ecosystem of institutions, actors, public development banks, the set of specialized funds, increasingly dedicated insurance products, that ecosystem is ever more complex and spans these different layers of protection. And yet, there are gaps in providing what's needed to the most vulnerable when disasters hit, to the most vulnerable communities, both in the short term and in the long term. And it seems that it's not fully working as a coherent system. So to address the needs of the most vulnerable, there seems to be something missing, and there's a slight mismatch. And these missing elements in the system become apparent and obvious as affected communities are suffering through these events and those losses with the increasing frequency. So at the level of the communities, these are actually felt. So such huge natural disasters at local community level are often coupled with an economic disaster of macroeconomic proportions that endures for a while, as we heard already. Recent events have completely devastated climate-vulnerable communities, and the reality of disasters due to climate change hits through ample and lasting damage. So they impose a physical and emotional toll on individuals, families, entire communities. And that long perspective of rebuilding after a disaster takes a lot of time and a lot of courage from those communities. So protecting the communities is urgent for having a people-centered approach to disaster risk finance. So how can we do better in supporting the most vulnerable? There are some elements that coexist and that all public development banks are very much aware of: investing in preparedness, responding rapidly, rebuilding in the aftermath of the disaster. But that takes a lot of planning for all three of these elements. It takes planning before disaster hits, and it involves having a very good understanding of the data, of the risk. And Alan exemplified this very well in the case of Mexico. It takes early warning systems to be able to know where and when to intervene, and knowing where and who to turn to. And what strikes me is that those who find themselves in such situations of natural disasters don't necessarily know how to access the support. And some of our research has shown that the proportion of those affected by disasters and that are actually seeking support from their governments, that proportion is generally skewed towards the wealthiest part of the population. So there's a need to communicate with the communities at that level and make these types of instruments more accessible to those who need to access support. And this type of discussion can't remain confined to a technical discussion amongst PDBs only, even across the different layers and with different private sector and other actors, but opening up that space to discuss with the affected communities appears quite important to really give this problem its full dimension and resolve the issues that remain to be solved. And, there's obviously coordination issues between the different layers of those institutions and actors that intervene at times of disaster. So that type of coordination really needs to happen, having in mind the best interest of those who are affected on the ground. Thank you.
Thank you very much, Valerie. Now we're going to have a final round, just 1 minute for each of you. And I would like, if you can, tell us, now that we have different partners for different sectors, different stakeholders and partners, I would like to know, maybe we can start even with Pablo, how collaboration between different stakeholders or partners could be enhanced?
Well, I think this is a very good first step, no? To start collaboration, to know each other, to see what each other is doing, to build trust between the different actors. And I think here, the role of MDBs, bilaterals, private sector financial players, the national development banks and the firms or countries at the end of the line. I think that building trust in all these, in those chains is very critical. And this event, Financing Common, the platform is very helpful for that. And then I think we have to find the structures that work and scale them. No, innovation is good. We have to continue, but once we find things that work, we have to scale rapidly. And I want to rescue one additional point, which is the one that Alan and Valerie made on resilience. A lot of the discussion typically goes to the products where you get the governments get the money and the insurance but less discussion takes place in this event sometimes about just pure resilience of people, firms, farmers, and I think we need to do much more on that, because once that's taken care of, then you need less too. So let me stop there.
Thank you very much, Paulo. I would like to be more relaxed if any of you would like to also to respond, or Christian, or...
I have to say that what Valerie said at the end, that really stroked me. I fully agree. I mean, this is a very elaborated discussion between specialists, and but what is lacking, maybe lacking, and I understand you. That's the result of your work, is that it's the knowledge of the people involved, the vulnerable groups, and you mentioned the importance of communication. So everything is here in this round, but not where it should be. So so that's quite an interesting thing to follow up. Yeah.
Thank you very much. Christian, Jan, would you like to add something on or respond how we can enhance this collaboration?
Yeah, well, I think that has already started. Certainly from our perspective, collaboration is absolutely critical. One of the things that we have appreciated and we have stated quite frequently is that given the needs, the extensive needs of, and I'm talking development generally, not only climate finance, but given the extensive needs of certainly our borrowing member countries, I don't think any single organization has the resources, or the comparative advantage to deal with everything. So partnerships and collaboration, these are things that are pretty much embedded. We have embedded in our DNA. With respect to climate finance, there are a number of partnerships and collaborations that we have. We have a climate action line of credit with the European Investment Bank, where we channel resources for climate action to our borrowing member countries. We have a community disaster risk reduction fund that is multi-donor. It's a trust fund with Global Affairs Canada, the UK government. We are working with the European Union, with the ACP. And of course, I can't forget the AFD. So partnerships are critical to us, and we are certainly heartened by the fact that we are evolving as institutions from competition to collaboration.
Thank you very much. Maybe just to finish, and maybe with you also, with Christine, I would like to ask you, how do you see the role of financing common as we are here in this event to try to address these challenges in terms of risk and how we're going to finance this? I don't know if we want to start with Christine or Valerie.
Well, I think one of the things that struck me today is that of course, there are gaps, but there are solutions. And as Michael said, these solutions are sustainable, they can be scaled, and they can mobilize the private sector, which is what we all want to do. And we also know that national and regional banks know how to work and innovate. But it seems to me a little bit that, as you mentioned, Pablo, there is really a need for more cooperation as we work all in silos, and it's still very technical, each one in his country or region. So, of course, finance in common is about that. It's about, mixing all regions and all types of stakeholders, and more, not only public development banks, but also regulators and so on, coming more and more to finance in common. So, I remember Remy mentioned at the beginning, what does it mean for the next steps? Maybe this is just food for thought. But what about an innovation lab? What about, how to share innovation on a more regular basis, maybe within Finance in Common? But that's not for me to say. It's for you.
Thank you very much, Christine. Valerie, Ruben, or Alan would like to add something to finish?
Well, on the same topic, something that we have learned is that when you talk about climate risk, resiliency, shocks, you mainly think about the government institutions, no? Most naturally, multilateral banks, second instance, public development banks. But the real challenge for us is not to import this technology and insert in our system, but to make this the state of affairs even with the private sector. That is something that we have put high in our agenda, how to share this information with the private players. The green bond, I will say that the most benefit we got from that green bond was not the money we got from the market, but the amount of information that we shared with the investors on what are the risks that our country faces, what is the life of a farmer before and after the intervention, how the money will be invested. And this is what we call collaboration, this is what we call involvement, and this is maybe what I will leave here as the real challenge for us.
Thank you very much, Alan. Valerie? Or
Yeah, I very much agree with what you just said, Alan, on the this level of intervention. I think it's very important to associate the specific groups in the community to devising the solution. And I think, Finance in Common already has a number of these elements. The right actors are here. And the only kind of missing element is this community level, the vulnerable groups that maybe could be associated in specific circumstances in the preparedness phase to devise those plans at national level or at regional level. And that could, possibly be, it's a possibility that could open up, given, the type of actors that we have in this room.
Thank you very much, Valerie. Ruben, or maybe Michael, if still it's online, to some short comment.
I can say a quick final comment. I would say we need to move more to execution. I've seen a lot of projects in which you have a lot of data, risk analysis, assessments, technical assistances, but it's hard to move to execution. It's hard to make all the partners involved to go to the next step. We need more CRIFs, Caribbean Catastrophe Risk Insurance Facilities on the world. We need more IDFs, Insurance Development Forums in the world. We need more Pacific Alliance cat bonds. We need more regional cat bonds talking about the Caribbean and other regions in the world. We need more global shields. We need more execution. That will be my final comment.
Thank you very much, Ruben and Michael, to close our session.
On my end, my final thoughts would be on the partnership. I think, one, I see the last mile business models need a lot of innovation to be able to see, because as you are mentioning, the community side, there is a challenge. We need to do a lot of thinking on, and even at the farms level, we need to think of the business models that are sustainable to them, or that they deem to be good business for them. And then the other thing is the win-win approach. And here I see several areas, things like the data access, who controls the data, things like the platforms. If you have a regional platform, how do people access it and feel it's part of their assimilated into their business, among others. And the last thing is we need policy incentives. I think not to forget policy. There are some incentives on policy that would make partnerships better. We need to keep investigating and getting country-specific policy changes that would help some collaboration possible. For instance, in the insurance distribution, each country may have their own frameworks that need to change. Thank you.
Thank you very much, Michael. I would like to thank all of you for this amazing panel. I think that basically, just to conclude, just some short ideas that I have taken note of all of you. Climate change is a reality, and we're going to address an increasing level of climate shocks in the upcoming years. And basically, I think that we need an important quality of adequate data to know how we are going to face and mitigate the risk. I think that also an important message here is how we're going to address a long-term commitment from different partners. These public-private partnerships are going to be really important to face the increasing level of climate shocks. And I would like to conclude with something that I really like that Valerie told us, and we need to discuss all these programs with the affected community. Definitely, sometimes when we are in the technical level of all these discussions, we used to forget the main consequences over the territories, and this is really important. Thank you very much for being here in Cartagena. Keep enjoying the event in the upcoming days, and thank you very much to all of you for being in this panel. Have a good night.